You're sitting in a car dealership, not because you wanted to be here, because your transmission died on the highway 3 weeks ago, and you've been borrowing your sister's car ever since, and she needs it back by Friday. The salesman comes back from the finance office. He doesn't sit down. He sets a piece of paper on the table, face down, and says, "So I want to be upfront with you." That sentence. You already know what's coming. You flip the paper over. The interest rate is 24.9% on a 5-year loan on a used 2019 Honda Civic with 74,000 miles on it. You do the math later in the parking lot on your phone. You'd pay $11,000 in interest alone on a $16,000 car.
By the time you're done, you'll have paid $27,000 for a car that's worth $8,000. You sign anyway, because you need to get to work. This is what a credit score actually is. Not a number, a tax, paid in secret by the people who can least afford it to the people who already have everything. Here is your life at every credit score level, from 450 to 850.
Level 1. Score 450 to 499. The system has decided you're a risk. You don't get a mortgage at this score. You don't get a car loan without a cosigner, and even then, the rate is punishing. Most credit card companies won't touch you. The ones that will charge you a $75 annual fee for a card with a $300 limit. That's 25% of your available credit eaten before you buy anything. Your landlord runs a credit check. You watch their face change. They come back with a counteroffer. First month, last month, and 2-month security deposit. 4 months up front. On an apartment you could barely afford with 1 month up front. You don't take it. You call your cousin.
Here's the thing nobody tells you about this score range. It's rarely the result of one catastrophic decision. It's the result of a bad 6 months that happened at the wrong time. A medical bill, a layoff, a breakup that split a household. The system doesn't distinguish between someone who blew money on vacations and someone who got hit by a car and couldn't work for 3 months. The number treats both the same. Your cell phone carrier runs a credit check. They put you on a prepaid plan. The phone costs $200 up front. Everyone else gets the same phone for $0 down. That gap, the gap between what you pay and what they pay, is the credit score tax.
And at this level, you're paying it constantly. On rent, on cars, on utilities, on deposits, on rates, on fees. You pay more for everything. Not because you're reckless, because at some point the system decided you were, and it's been collecting ever since. The rule at this level, every dollar you borrow costs you 2. Level 2. Score 500 to 579.
You exist. That's about it. You get approved. That's the news. You get approved for things. Not good things, but things. A secured credit card. You deposit $500, they give you a $500 limit. You're borrowing your own money, and they're charging you interest on it. If you're late once, the rate jumps to 29.99%. You read that and think, they have to be joking. They are not joking. The car loan you get at this tier has an APR somewhere between 18 and 22%, depending on the lender and whether they're feeling generous. The subprime auto market is an industry unto itself. There are dealerships that specialize in customers with scores in this range.
You'll see signs that say, "We finance everyone," and "No credit, bad credit, no problem." No problem for them. The problem is entirely yours. What the 500 score actually means day to day, you call your insurance company to switch from paying monthly to paying every 6 months to get the discount. They run a credit check. The quote goes up. You didn't know they could do that. Most states let them. You apply for an apartment in a nicer part of town. The management company has a minimum score requirement of 620. They don't tell you this until after you've paid the $50 application fee. Non-refundable. You apply somewhere else. You get it. But the building is older. The neighborhood is louder. The commute is longer.
You're paying for your score in time, too, not just money. At this tier, the improvement game begins. You start treating the secured card like a debit card. Buy groceries, pay it off. Buy gas, pay it off. Don't carry a balance. Don't be late. This is boring. It works. The rule at this level, you're not building credit. You're proving a negative. You're proving you won't vanish.
Level 3. Score 580 to 619. The on-ramp. Things start to become possible. Not good, possible. You get a real credit card offer in the mail. Not a secured card, a real one. The limit is $500. The APR is 26%. The rewards are non-existent, but it's unsecured. That matters. You get approved for the apartment without the extra deposit, just first and last. The landlord still calls your previous landlord. They still linger on the application a moment too long, but they hand you the keys. This is the tier where the credit card utilization game becomes critical. You learn, through a Reddit rabbit hole at 11 p.m. on a Wednesday, that keeping your utilization below 30% is the minimum. Below 10% is better. You have a $500 limit. That means you should never have more than $50 on the card at any given time if you want your score to actually climb. $50. That's the ceiling that matters. On a card that, if you miss a payment, will charge you $40 in fees and report you as delinquent. The car market opens slightly at this tier. You'll find lenders willing to work with you. The rates are still ugly, 14 to 17%, but you're no longer in the predatory subprime zone. The difference in monthly payment between a 17% rate and a 7% rate on a $20,000 car is about $100 per month. That's $1,200 a year. That's the tax. Here's what changes at this level that people don't talk about. You start to believe it's possible. Before this, the number felt fixed, like something that happened to you and would keep happening. Now it moves. You check it every week. You watch it tick up 2 points, then 3, then back down 1 because you accidentally let the balance sit too high. It becomes a small obsession, a project. That obsession is healthy. It's the engine. The rule at this level, the score is a lagging indicator. The behavior has to change first. The number catches up. Level 4, score 620 to 659. The gear shift. You qualify for your first real loan. Not a great loan, but a real one. If you want to buy a house, which at this point you're thinking about for the first time as an actual possibility, not a fantasy, an FHA loan will take you at 580. But at 620, you start to see more options. Conventional loans are still mostly closed. The rate you'd get on a 30-year mortgage at 625 is meaningfully higher than what you'd get at 720. The spread can be 1.5 to 2 full percentage points. On a $300,000 mortgage, that's roughly $100,000 in additional interest paid over the life of the loan. $100,000. Because of a number that moved 95 points. That is the magnitude of what you're working with. But here's what else happens at this tier. You start to get recruited. Credit card companies start sending you offers with actual rewards, 1.5% cashback, no annual fee, $1,000 limit. These feel like a big deal, and they are. Not because of the rewards are minor, but because what they signal. The system has reclassified you. You were a liability. Now you're a potential customer. Your car insurance quote drops. Not dramatically, but you notice it. You start to understand that the credit score isn't just about borrowing money. It's a proxy character assessment that follows you everywhere. Landlords use it. Employers in some states use it. Insurance companies use it. Utility companies use it. It is a numerical answer to the question, how does society rank you as a financial participant? At 640, you're average. Globally, the average American credit score is around 714, so you're below average. But you're no longer in the basement. The rule at this level, you've escaped the penalty box. Now you're on the ice. You still have to learn how to skate. Level 5,
Score 660 to 719. The invisible upgrade. Nothing dramatic happens at this tier. That's how you know it's working. You stop getting declined, you stop bracing for the conversation. You apply for things and they come back approved, and you feel a low-level relief that you didn't even know you were carrying until it was gone. The credit card offers are better now. 2% cash back, a $5,000 limit. Some of them have sign-on bonuses. Spend $500 in the first 3 months, get $200 back. You become the kind of person who has 3 or 4 credit cards and pays them all off each month. The kind of person who never pays $1 of interest. The cards are a tool, not a trap. The car loan you got last year, the one at 14%, you can refinance now. You call the credit union, they quote you 7.5%. You do the paperwork in 20 minutes. Your monthly payment drops $85. You didn't earn more money. You didn't work harder. You just waited. This is the tier where the math starts to quietly flip. At $450, the system took money from you. At $700, the system gives you money back. Small amounts, yes. Cash back, refinancing savings, a slightly lower mortgage rate, a deposit you don't have to make. But the direction of the flow has reversed. Instead of paying a tax for being low trust, you're collecting a small subsidy for being trusted. The psychological shift is just as significant. You start thinking long-term. The credit score becomes less of an obsession and more of a background process. You check it once a month. You don't panic when it dips 4 points because you opened a new card. You understand the system well enough not to fear it. The rule at this level? You're not grinding anymore. You're maintaining. The compound effect is doing the work. Level 6, scores 720 to 779. The system starts courting you. The mortgage broker calls you an excellent borrower. You have never been called that in your life. At 740, the conventional mortgage market opens fully. You're getting the best available rates from most lenders. The spread between 740 and 800 is almost nothing, maybe 0.25%. You've effectively maxed out the practical benefit of the credit score for mortgage purposes. The same is true for cars. A rate at 740 and a rate at 800 look nearly identical at most lenders. You've passed the threshold where the score stops translating into meaningful savings. What you gain at this tier is something harder to quantify: access without friction.
You want a $20,000 personal line of credit for a business idea? Approved. You want a travel credit card with a $15,000 limit and a $500 sign-on bonus? You have 3 to choose from. You want to rent an apartment without anyone even running a hard check? The leasing agent doesn't bother. The premium credit card companies start reaching out. The ones with the metal cards, the ones with the airport lounges and the travel credits and the concierge service. These cards don't make you wealthy, but they signal to the people around you. The hotel front desks, the car rental counters, the restaurants with the good seats near the window, that you are a person who has been pre-approved by the financial system.
That signal has real-world value. Here's what's strange about this tier. The financial habits required to get here are almost invisible to the people around you. Nobody knows your credit score. Nobody knows you pay off your cards every month, that you keep your utilization at 6%, that you have 5 years of pristine payment history. You look like everyone else. But underneath the surface, the architecture of your financial life is completely different from where you started. The rule at this level? The score is a reflection of a system. You don't maintain the score, you maintain the habits. The score is just evidence. Level 7, score 780 to 885. The reward for not needing it. The irony of an 800 credit score is this: you get it by not needing it. At 820, you can borrow more money at better rates than at almost any other point in the system. But the people who reach 820 are almost always the people who are least likely to borrow money at all. They have savings, they have investments, they have options. They don't need to finance a refrigerator. They don't need to put medical bills on a payment plan. The score is highest when the borrowing is lowest. Day to day, an 830 doesn't feel different from a 760.
The mortgage rate is the same, the car loan rate is the same. Most of the benefits plateaued 2 tiers ago.
What you have at 830 is a ceiling, the absolute maximum the system will offer you. The best rate, the highest limit, the lowest deposit. But the real value of this score isn't the rate, it's the speed. When you need money, you get it. Not in a week, not after 3 days of underwriting, same day. Pre-approved, pre-qualified. The emergency that would have capsized you at 480, the medical bill, the car repair, the short month, is now a Wednesday afternoon errand. You pull from a line of credit, you pay it back in 60 days. No panic, no payday loan.
No calling your parents. The cushion that this score represents took years to build. Most of it was invisible. Most of it happened during the stretches where nothing went wrong. When you kept paying on time, kept the balances low, kept the accounts open. You didn't notice it growing. Neither did anyone else. And then one day, someone at a bank called you an excellent borrower. And you realized the number isn't who you are. It's proof of what you did when no one was watching.
You're back in that car dealership. Different dealership, different year, different score. The salesman comes back from the finance office. He sits down this time. He smiles. He slides the paper across the table. The rate is 5.9%. You're approved. No cosigner, no proof of income beyond a bank statement, no extra fees. You remember the last dealership, the paper that was placed face down, the rate at 24.9, the $11,000 in interest on a car worth $8,000. Same person, same country, same year, just a different number. The credit score doesn't measure your character. It doesn't know what happened the year things fell apart. It doesn't know what you sacrificed to dig out. It doesn't know your name or your story or what it cost you to get here. It's just math. But the math has consequences, and the people who understand that earliest pay the least for it.